whenever these chemical plants all start coming online in 2016 and 2017, right? If we are going from about $90 billion in investment in the Houston region for all of the plants combined, not just the natural gas associated ones, but right, it was not unreasonable to assume that the Houston region outside of Pezoria probably has about twice the investment that Pezoria does. Right? So let's just do three times this much. Three times this. We would have $90 billion, $80 billion in investment. And then whenever the plants all start being finished, I don't know where they're finished. When the plants all start being finished, right, we see 2016, 2015, 2016, 17, 16, 14, 18. Right? When they all start coming online in 2017, we're going to lose 40 or 50,000 temporary jobs and gain our 10,000 permanent. Permanent jobs will be much higher pay, much more stable, right? But that is going to be that period between 2016 and 2018, right? I'm guessing that it's going to show up in the data as lower employment growth because we're going to be losing, say, 20,000 construction jobs a year for that time period and only adding 2,000. And then when you hear people forecast about this stuff too, you have to be worried. So one of the things that's being constructed are LNG plants across the United States. Right? And so right now the international market trades 32 billion cubic feet of liquefied natural gas a day. If you looked at every single proposed and Department of Energy applied plant as of right now, we would add double the size of the market. If every proposed plant got built, we would double the size of the market. As of right now, right, if you could trade LNG from Freeport, you would be making a lot of money. Right? You could buy gas, natural gas for $4 per billion cubic feet. Right? Then you can freeze it for about another 4, and then you can go to Japan and sell it for, I think it's like 18. Right? So you make $10 off of every billion cubic feet. Right? And our plant in Freeport is going to be 1.8 billion cubic feet. That's up. The metric that we sell it. Anyways, and so you can sell it in an extraordinary cost. But if we double the worldwide market, I don't think the price of gasoline or the price of Japan would stay at 18. Right? And even if, right, so the ones you have to get Department of Energy approval and you have to get Federal Energy Regulatory Committee approval. And so even the ones that have gotten both of those, right, which includes the plant down in Freeport and then 2 on the Sabine River. I think they're actually both on the Louisiana side of the Sabine River, but they're right on the Sabine River. And then 1 up in Virginia. Right? If those 4 all actually get built, then we're still increasing the size of the market by an additional quarter. And so this is some of the danger of what's going to happen, right? This is why I'm worried. Well, I'm not worried. This is why I can't say what's going to happen after 2017, 2018. These plants are going to be built, they're going to run, and they're going to operate. Right? There's going to be a short-term fluctuation where we're going to lose the temporary jobs and gain the engineering and the operators' jobs, which are better jobs anyway, better pay and more stable. Right? But what's going to happen after all these plants come online is going to depend on what happens to the prices of natural gas, condensate, and light petroleum. And then for all of the other plants, right, all the things that the other plants are producing, what's going to happen to the price of ethylene and propylene, which then go into making plastic, and what's going to happen to the price of plastic is going to determine whether or not the boom in the upstream can continue. Yes, sir.
Does your model contemplate any increase in basic manufacturing onshore as a result of lower feedstocks? And how much of that would you anticipate might come to the greater Houston area?
Okay, I see. So the downstream from the downstream.
Right.
Right? Well, you know what? I was getting into this, and I thought of that last week. I've been trying to figure out, but I am not sure about the chemical, right? So that's part of what we're talking about. Are they going to respond? And since now polypropylene and polyethylene are so much cheaper, right, then people should start using that to produce the plastics more and produce more plastics, and so we'll get plastics on everything even more than we already have. And yeah, so there will be a response, and that's what I'm saying. I don't know what that response will be.
Some rebound there.
Right, there should be, and hopefully, right. Well, I mean, for the idea of sustainability and smoothness, right? Hopefully, we're under investing right now. All of these plants will be finished and start finishing in 2016. Everybody will realize the prices are going to work out, and we'll just continue investing, and it will stay smooth. But I doubt that part is true. And so that's what, it's hard to tell when you get into that. I mean, that's what, as far as my model goes, that's going to happen, but I can't say anything about the scale. All right, and so then 2016 and 2017, right, will also represent just your labor shortage will finally start easing, but right as also, right, the boom in commercial and manufacturing and retail is pretty much also dependent on the new money and new workers coming here because of the investment in downstream. And so that your labor shortage will probably ease coming 2016, 2017, but the difficulty might also be that the demand for new office space and new manufacturing might also be easy. And so we have our negative effect. Okay. All right, so this is everything again, and so then this is what I think is what we hope, or what I think is going to happen. Down here, the downstream is going to be strong. Midstream is already strong, but so somewhere around 2016 to 2018 is where I'm predicting that we're going to go off of that 4% trend and come down to our 2% trend, right? Allowing for the business cycle. Okay. So here in the construction. I know I'm a little over, it's all right. Yeah. So here's what I've done now. All right, so that's, yeah, well, let's go back and talk about this. All right, so the demand growth for your real estate and also your labor shortage are going to ease as these booms in the midstream and in the upstream wind down. And the midstream, I think, is already, or it is already slowing. And I'm expected to pick up again. And downstream will be strong. Right? We're still going to have people coming in and building these plants up to 2016, 2017, 2018. Right? But towards the end of that is where I expect the shift to go back from our current 4% to our 2%. Taking into account too this employment cost, right, that is just going to show up in the numbers because right now we have 5,000 people building plants for every 500 who are going to end up working. Right. So unfortunately, right, so the labor shortage will ease, but about the same time as the demand for your product is going to ease. And I'm expecting a return to a 2%. Right, and then right, the only thing here, right, it could be 2% is just our long-term trend for as long as I can go back and stuff. Yeah. And it's actually a really good number. I mean, it's still definitely better than any of the cities that are larger than us. We're catching up to everybody, and it's still better than most of our comparable cities. The 2% isn't some significant level of economics math, other than recognizing that that was the old trend. And I expect, right, the economics does tell us that we expect to go back down to some trend rate between after this catch-up growth and the technological innovation. Okay. Okay, so here's residential construction. And so essentially what I've done here is I'm comparing the residential construction, right, or construction permits, and this counts single-family homes as one unit, and then each unit in multifamily homes as one unit. And it compares it to the new units per new population, okay, for every year. And so on average, since 81, it's been 3.9 new units, or 0.39 new units, which represents a household size of 2.82 on average. And so that's my magic number. You know, you hear other people talk about one apartment unit per every new job, or for every 6 new jobs or something like that. And so the red line here is our average. And so what's happened here now in 2014 with relatively conservative, I believe, estimate on the population growth. Right? So I think our population growth is actually going to be better than this. Right? And so then that makes this excess construction in 2014 will be lower. Right? But we're still seeing strong, in the market today, we're still seeing strong upward pressure. Right? So we still only have 3 months single family inventory. Apartment occupancies are up. Apartment rents and home prices are still increasing. Right? So we've had very high increases in housing prices for the last year and a half. Right? And that is representative of our under construction for the last 5 years. Right? So that we haven't been building enough housing units for our population growth over the last 5 years. And so that as of right now, right, I would say that the short-term excess growth is just going to be catch up from our under construction in 2008 and 2013. And so that for now, what I'll expect to see is lower price increases. If we continue to permit more relative to our increases in population, right, then we will start to worry about actual overconstruction, where we see prices fall and we continue the cycle that we've always had. But as of right now, it's just catch up and it's doing to slow the rate of price increases in homes and apartments. It's also a leading indicator, right? It's a permit coming in today. Some of those are apartments, so that won't come online for 2 or 3 years. Some of those are houses, so a year at best. Right? And so it's still a leading indicator, and so I would guess that we have a couple more years of increases in prices, just at a slower rate. Retail construction, again here. So here I've subtracted the retail growth rate from the population growth rates. And so that when we're above 0, that means that the square footage added, the percentage of square footage added in retail was greater than the percentage added in population for that year. Right? So we had our boom before the financial bust and for a couple of years after. Right? And then we've been underproducing today for the last 3 years. And then again, I put in conservative population estimates on growth for this year. And I assume that all square footage currently under construction is completed. Right? And so this is using numbers from June. Right? But both of these are very conservative estimates, which means that the percentage increase in retail compared to the percentage growth rate of population is actually going to be negative this year. And so that you can reasonably argue that we're still underproducing retail. And so that we don't really have to worry about it being a boom or a bubble there yet. We're not building too much, at least. It's grown fast, very, very fast over the last year and over the last quarter, and so that will bear watching. Fortunately, the light industrial construction, oh yeah, so all my numbers come from CBRE, but all the analysis and presentation is not mine. Light industrial construction, very difficult analysis because of the high variability, and it's hard to say that we're safe here because we haven't had a persistent period of under construction. Right? But I think it's very safe to say 2 things. Right? That the light industrial is going to be the one that's been most influenced by our construction boom in the midstream and the downstream sections. Right? And so that we would expect them to be overrepresented in growth with this technological change. Right? And so that it should fall down with our shift back to our 2%. And then also, what I say is not because of what we're building today that's going to be the bust. And And now commercial is the scary one. But again, I used my very conservative estimates of employment growth. Right? So this is employment growth assuming that it's going to be 75%, which was the consistent prediction for employment growth in January of this year and October of last year. Right? And it turns out that it's actually going to be about twice that size, about 110,000 instead. And then if we put say that all of our construction would be finished this year, right? And again, this is as of June of this year. Right? We still had 16 million under construction if you finish, and so this is if it was all finished this year. PM Realty was just had a report out in the Houston Business Journal, right, where they actually gave me a number on how much they believe was actually going to be constructed this year, which was 5.4 million square feet. And for a total amount of constructed this year of 9 million square feet. And if we use our actual or most likely employment growth, then it is going to exactly match the employment growth. And so that it appears that commercial is going to be everybody else's way under, except for the residential permits, which are a leading indicator by a year or 2 years. And so that it appears that commercial is going to be, or office construction is the one that is closest to being in that area where we might start thinking or worrying about it being a bubble. I wouldn't say so yet, right? Because also the new report from PM Realty is now 19 million under construction. Right? If we continue finishing at 9 million, right, then we're actually going to keep about the same amount of growth. And so I think we're still in pretty good shape. If we continue to see the numbers increasing on under construction square foot, that's why when I would start getting more. Yes, sir.
Could you repeat the question, please? We can't hear it over here.
Oh, if he has what percentage or how many of this square footage is the Exxon campus that's going to be completed today? I'm not actually sure. Anybody remember the estimate of the size of the Exxon campus? Okay.
3 million.
About 3 million of it? Yeah. And so then that's a one-off, right? They've been messing up our numbers a little bit because they all of a sudden moved all their people from Virginia, and so all of a sudden 20,000 people work here. And that's a big part of why we think that we a small unemployment growth. So about 3 million of that being completed. I think the key to watch is we're finishing 9 million this year. We got 19 million constructed, which means like if we did an inventory like they do in residential real estate, then we have about 2 years inventory for constructing. And average construction time for the office is about 2 years, 3 years. And so that we're actually in pretty good shape. We're finishing 9 million this year, which puts us actually at this exactly equal with employment. We have about 9 million that should be completed in the next 2 years. And so I think we're still in good shape, unless we see that under construction number continue to go up. Okay. So everything else is just, I know I'm a little bit over, everything else is just reiteration of the things that I said, and y'all have the slides. So then my final here is the boomer bubble. Not yet, and actually I don't believe, right, the industrial ones is really the only one that I can't be confident in saying that it's not a bubble yet. And I see no reason to say for sure that we are going in. And then also I passed out these things. We're giving our symposium at the end of November, and you'll have Dr. Gilmer there speaking more broadly about the economy and not just focusing on the oil and gas. And our updated revision, we're actually predicting what's going to be happening next year. Do we still have time for questions?
We're going to break right now. Thank you very, very much.